It's probably one of the most tempting and, yeah, one of the most dangerous moves in all of investing, trying to catch a falling knife. Today, we're going to break down why we are so drawn to these situations and, more importantly, how you can learn to avoid getting seriously cut.
Oh, come on. We've all felt this, right? You see a stock chart that looks like it just fell off a cliff, a company you actually admire, now at a price that seems like an absolute, undeniable steal. That temptation, it is huge. But jumping in without thinking could be one of the biggest mistakes you'll ever make with your money.
So, what are we actually talking about here? What is this thing that traders gave such a perfectly grim name? Let's get right to the heart of what a falling knife really is. Okay, picture this. The downward momentum of the stock is so intense, so powerful, that it just slices right through all the normal price levels where buyers would usually step in and say, okay, it's cheap enough, I'll buy here. Those support levels, those floors, they just vanish. It's a genuine free fall. Now, a price drop this severe doesn't just happen in a vacuum. Nope. There are some really powerful forces creating this kind of perfect storm. Let's pull back the curtain and look at the three main reasons this happened. All right, first up, you have fundamental shifts. This is the real deal bad news. Stuff like a disastrous earnings report, getting hit with a massive lawsuit, or maybe a new regulation that just guts their whole business model. Then there's pure market sentiment. Panic, as you know, is incredibly contagious. One person sells, that triggers someone else's automatic sale, which causes even more selling, and you get this feedback loop of pure fear. And last, and maybe the most painful one, is the value drop. This is when the stock looks cheap for a very good reason, because the business itself is actually broken. Okay, so we've established it's incredibly dangerous. So why on earth do so many smart investors get tempted to reach out and grab it? Well, the real fight isn't just on the stock chart. It's happening right inside our own heads. This slide just nails it, doesn't it? It shows the two powerful, primal emotions at war inside of us. On one shoulder, you've got FOMO, that nagging, anxious voice saying, if you wait any longer, you'll miss the absolute bottom and lose out on all that profit. And on the other shoulder, you've got your own ego, whispering, you can be the hero who calls the bottom. You can be the one who was right when everyone else was scared. Both of those are a recipe for financial disaster. And here's the antidote, summed up perfectly. Look, nobody gives out trophies for buying at the absolute lowest price of the day. The real prize is simply being right about the long-term direction. Trust me, it is so much better to miss the first 10 or 15% of a recovery just to be sure it's real than it is to jump in too early and end up losing another 50%. But listen, inside this whole falling knife scenario, there is one specific trap that is just incredibly dangerous. It preys on your hope, and it's responsible for just countless investor losses. It's called the dead cat bounce. So here's how it gets you. After a stock absolutely plummets, the price will flicker back up a little bit, maybe for a day, maybe for two. And hopeful investors, they jump up and down shouting, this is it, the bottom is in. They all pile in, thinking they're geniuses, only to watch in horror as the stock rolls over and continues its catastrophic plunge. It's a textbook trap.
And that's exactly where that gruesome name comes from. This old Wall Street saying is a pretty grim reminder that a small, reflexive bounce doesn't mean the stock is alive again. It's just physics. Okay, so after hearing all of that, you might be thinking, all right, I get it. Just run away screaming anytime a stock drops hard. But that's not quite right. The key here isn't blind fear, it's professional preparedness. And believe it or not, there is a way to tell the difference between a dangerous trap and a genuine once-in-a-while opportunity. Stick with me and we'll walk through how to do exactly that.
So let's be clear, the goal is not to catch the knife while it's still hurtling through the air. The goal is to wait for it to hit the floor, stop shaking, and only then carefully consider picking it up. So here are the signs that tell you the immediate danger has likely passed. So what is the proof we're looking for? First, consolidation. The free fall has to end. The price needs to stop making new lows and start trading sideways for a while, building what traders call a base. This shows the panic is subsiding. Second, you want to look for a huge spike in volume. This often signals that final desperate wave of selling right before the big serious buyers step in and take control. And third, the narrative has to change. The market has to stop obsessing over whatever the bad news was and start looking toward a path forward.
This visual shows you exactly what I mean by volume. See how during the slide, the volume is just kind of average. But then right near what turns out to be the bottom, you see that one enormous bar. That's what we call capitulation volume. It's a massive sign that the last of the sellers have finally given up and thrown in the towel, and the big institutions are now stepping in to scoop up shares. That is a very, very powerful signal.
Okay, let's wrap all of this up into a simple, easy-to-use playbook, something you can refer to anytime you feel that temptation to go knife catching. Let's keep it to 4 simple rules. Rule 1. Never, ever buy a stock just because it's cheaper than it used to be. That's how you get hurt. 2. Observe the momentum. Is the selling pressure finally letting up, or is it getting worse? 3. Wait for confirmation. Look for what's called a higher low on the chart. That's a classic sign the trend might be reversing. And finally, number 4, always protect yourself. If you do decide to enter, use a stop loss. Decide before you buy at what price you will admit you were wrong and get out. No exceptions. And that right there, that's the key to this whole thing. Remember that question we started with? That gut feeling screaming at you to buy that great company that's 50% off? The answer isn't to kill your instincts, it's to educate them. You arm your gut with evidence, because a true bargain comes with proof of a real turnaround, not just a lower price tag. Thank you so much for joining us at King's Academy for this explainer. We really hope this gives you a solid framework for the next time you see one of these very tempting situations. And now we'd love to hear from you. What's the biggest value trap you've ever fallen for, or maybe one you skillfully avoided? Share your story in the comments below. We read and reply to every single one. Until next time, stay safe out there.